Well, the banks have been reporting their numbers, and top of the list, we shall be speaking to Absa Chief Executive Officer Jeremy Awori, who's one of the key figures when it comes to the banking sector, and we'll be interrogating just to see where is the bank headed in regards to the full year results. They've just released their half year results, and we've set up right behind me. We'll be speaking to him in a short while. Make sure you join us for that conversation.
Jeremy Awori is the Managing Director and Chief Executive Officer of Absa Bank Kenya PLC, part of Absa Group Limited, a position he assumed in February 2013. Prior to joining this organization, he held various positions within Standard Chartered Bank, among them CEO of Standard Chartered Tanzania from 2008 to 2012, Regional Sales and Performance Director at SCB Middle East, South Asia and Africa from 2005 to 2008, and Head of Consumer Banking in SCB UAE from 2003 to 2005. He also served in Standard Chartered as the Executive Director and Head of Consumer Banking for East Africa. In addition, Jeremy has lived and worked in the UK, North America and Asia. He completed his master's degree in Business Administration from McGill University, Montreal, Canada, and holds a Bachelor of Science degree in Pharmacy from Manchester University in the United Kingdom.
Such a pleasure to have you on the program.
No, thank you. It's great to be on the program today.
Well, it's the results season. You've just reported some very good numbers, 13% up on your profit after tax. And talk to us about how you're feeling about the performance.
No, we're very pleased with the performance. The last 2 to 3 years have been quite challenging for everybody. And then obviously, as we thought we were seeing the end of COVID, then we've suddenly lurched into the Ukraine-Russia situation, which we're feeling the impacts of right now. So as a bank, we continue to execute our strategic agenda, and we're pleased and glad to see the results coming through, whether it's in top-line growth at 17%, which is the fastest we've seen in over 15 years. Our costs are quite well managed. Our cost-income ratio is good at 42% when we had committed to be under 50, which is an improvement on last year. We're pretty pleased with where we are at this point in time.
And talk to us about the revenue generators. You recorded a 17% jump in total revenue, hitting 20.9 billion shillings.
Yeah.
And we've also seen an interesting trend when it comes to interest income, I beg your pardon.
Yeah, I mean, I think the thing for us that drove a lot of our performance was we are lending to customers, and I think that's very important. Our lending to customers grew 20%, which is significant in and of itself, because everyone is kind of concerned about the environment, and I think banks pull back on lending, and we clearly showed that we are lending. And then we've seen also our businesses, we've invested in new businesses, and those businesses are starting to contribute to the top line growth. And I think for us, what is exciting is all our businesses now are growing in double digits. In the past, maybe one business would shoot ahead and the other one was building momentum. So I think that gives us the confidence that it's a diversified, sustainable growth. And we've really put an effort around sales and service. And that's what is very pleasing, that it's coming through in the results. It's coming through in the sentiment now in this, in this market. I think it just kind of shows the effort we're putting in. I think is starting to deliver the results we were looking for.
And interesting, Jeremy, that you bring this up in regard to pre-pandemic numbers. Would you say business recovery has gotten back to normalcy? Because I'm looking at your customer numbers as well as the customer loans that you've been able to dispense. You're seeing some good numbers coming in. It was about 262 billion.
Yeah, correct. Yeah, I mean, I think we're definitely seeing, like from the bank's perspective, we're ahead of the pre-pandemic numbers, which I think is very encouraging. I think from a customer's perspective, it depends really on the sectors, right? I think COVID really interfered with trade movements. People couldn't import as much, and there was uncertainty, and lockdowns really affected that. So I think that is definitely coming up. We're definitely seeing improvements in the hospitality and service sectors. I think tourism, we know, is not back fully to the pre-pandemic numbers, but the numbers are shooting up. So we're seeing a lot of, like in our side, we're seeing growth in trade, mortgages, service industry, manufacturing, and I think those are the areas which also create employment, and I think that's very important to drive GDP. Yeah.
And speaking about these sectors, we are just from an election, from where you sit, which areas are going to be defining the bank's next half-year forecast?
Yeah, I mean, I think there's still various uncertainties that are out there, and I'm thinking that's more around the macroeconomic environment. You know, so I think there's optimism within the Kenyan sphere of doing business, and I think what I've liked about this situation is that even with elections, there's optimism, and I think that shows a maturing democracy. It shows that business should continue either way. Elections are part of a political process, but business should continue and the economy needs to continue to grow. I think what we do need to watch is the macroeconomic environment. We're coming into winter. The Russia-Ukraine crisis is still on. You know, you can have big moves here and there that could affect us. Obviously, there's been lots of talk of recession. We're also seeing, you know, we have to watch and see what happens with diaspora remittances. Thankfully, they've held pretty strong. Sure. But as expenses go up because of inflation out there, we've really got to work hard here to make sure we keep the economy growing. But it is very positive that the sentiment is up. You know, and hopefully after the elections, we'll start seeing more FDI coming back into the country. Because if there isn't those investment opportunities out there, and we're still growing at plus 5%, GDP, it's an opportunity.
Interesting. And Jeremy, you've touched a very important nerve when you talk about economic growth prospects and looking at the GDP and listening to the regulator, Central Bank of Kenya, Governor Dr. Patrick Njoroge. He's quite concerned about the level of non-performing loans. And as a bank, how are the numbers looking like? We of course did see Absa taking on a front lead position when it comes to supporting businesses at the height of the pandemic. And this did see quite a number of sacrifices being made by banks like yourself and others. But really, where are we in regards to the MPLs? Is this keeping you awake at night?
Yeah, I mean, it's definitely something to watch closely. Because we've seen the NPLs grew. They were 13%, you know, last year. They grew to 14% in April, I think. Now they're at 14.7%. You've seen the recent article which indicated that defaults have crossed $500 billion shillings. I think it's inevitable coming out of the COVID crisis, seeing the inflation impacts, that the impact on disposable income is quite severe. So the inflationary impact cannot just be passed on customers. So inevitably there'll be some levels of default. So that's obviously why we need to trigger economic growth, trigger more jobs so that people can afford to continue paying their loans. But I think it's something definitely we have to watch because obviously it will directly impact us. So banks' choices around where they lend are going to be vitally important, and then how they work with customers if they do meet with difficulties, because I think there's a big difference between unwillingness to repay and inability to repay. And
looking at the forward look in regards to where is the bank seeing opportunities now, especially there's a lot of vibe around digital lending. It's evolving quite fast. We're seeing a number of institutions trailing their resources towards that unit, and it's emerging as a very critical revenue driver for quite a number of institutions.
Yeah, definitely digital lending is a huge opportunity, and I think it's filling a need. I think what, as financial institutions, we all need to make sure is that we manage our customers' debt levels carefully, because we don't want people to get over indebted or and to start struggling from that perspective. But I think there's a lot of other opportunities that we see. there's opportunities in bank assurance, for
Yeah,
example.
yeah.
We've only got insurance penetration of 3-4%, and if we can insure our risks better, then it helps improve the financial strength of individuals and companies alike. So bank assurance is one. You've seen we've recently launched the asset management business, and that, we've launched our unit trusts. And what we want to do is democratize the investment ability to get higher yields. So you can, for 1,000 shillings, you can buy into unit trusts. You can save, over the long term. And so it's not something for the preserve of the wealthy, right? So it gives more investment options. And then for us, we're also investing in our corporate and investment bank into setting up an investment banking business. So we're recruiting for that. And that will deal with all the M&A, equity and debt financing options. And we're seeing a lot of, obviously, foreign direct investment interest. And I think as that starts coming in, they're going to need advisory services, along with custody services, along with brokerage services. And these are all businesses that we're looking at. And that's on top of just supporting SMEs with their unsecured lending, working capital requirements, trade finance, foreign exchange, you name it. So we see actually broad opportunity for growth. And our approach is really a diversified growth strategy. That way then we can better manage risks depending on how they come in the future.
And allow me to take you back on a point you've talked about around bank assurance. It's sort of a greenhorn for quite a number of banks. How has been the experience for Absa, and are you already beginning to see a return on investment?
No, absolutely. I mean, for us as a bank, we were only authorized due to the change in regulations to get into this business around 4 or 5 years ago.
Yeah.
Within that space, we've grown our business substantially, and we're now a top 3 bancassurance player from almost a standing start. So these businesses are businesses that generate more than 1 billion shillings revenue for us, and we see huge opportunities for growth because they say there's under penetration. So I think if people think through the benefits of insuring their risks, yes, you're paying premium, but if things do go wrong, you're better covered. So for us, it's a big opportunity. We're investing in that team and we're getting a good return.
All right.
Yeah.
And as we come to the tail end of our discussion, I'd like to know, how is the bank positioning itself to tap into an emerging area such as the trade finance, where we're seeing a lot of young entrepreneurs? Tier 1 banks, Tier 2 banks have sort of shied away from that niche market. I don't know, what's the case for Absa?
Yeah, I mean, what we've done is we work very closely with our customers to understand their needs. So we've got various propositions that are there. They told us the areas where they were finding us not as responsive. And we've done a lot of work to change that. So whether it's turnaround time on bid bonds, guarantees, trade finance options, use of digital. So you'll have seen recently we launched our Visa send money proposition. So all of a sudden you can, through your card, send money to different parts of the world to make payments, right? We've launched our Women in Business proposition, which again is training people around how to set up businesses, how to work your networks to grow your businesses, as well as giving finance. We've got invoice discounting up to 50 million. We've got unsecured facilities of up to 10 million. And again, these will just help businesses as they set up, to be able to grow. So for us, we're very much excited about that opportunity because we feel that startups, SMEs are going to be the engine of growth for the economy, but also importantly create employment. So I think there's the financing side, but then there's the support in terms of skills, how to get your business to survive, because we know it's tough to get your business to make it to the 3-year point. And if you do, then your chances of success are even better.
Speaking about things being tough, Jeremy, we've also seen an interesting trend when it comes to risk-based pricing. It's one of the models that the regulator believes will have a huge bearing in regards to reducing interest rates. I'd like to pick your mind on this. How is this going to play out? Is it something the bank is taking up on its strategy?
No, absolutely, and we were very excited and pleased to get central bank approval for our risk-based pricing model. I know a number of banks are still going through that process. I think what's exciting about risk-based pricing is that it gives banks the ability to price risk much better by customers. Because all customers have different risk profiles.
Yeah.
And what we found was happening is some of the higher risk profiles, banks could not get a return on their investment. So they just essentially stopped lending into those segments. And personally, for me, what I found was those people still may have needed financing, so they went to alternative sources of financing, which were much more expensive and put much more burden on them. Some could even have gone to loan sharks, etc. So unregulated types of financing in some ways. Whereas now, the fact that we've got a bit more room to be able to price for that risk, I think they should be able to access cheaper finance in a more regulated way, and I think that will be good for them. So over time, what we expect will happen is depending on your risk profile, I think the pricing could improve, for especially for those better performing kind of loans. The people who always diligently pay, have paid for years, they'll either find they're able to get bigger facilities or they're able to get better pricing on their facilities. So we're pretty excited that that's the right way, and pleased that we got our approval.
All right. So do you feel this will usher in an era of much more cheaper loans for Kenyans?
To be honest, I don't see it as coming. It's not something that's going to come immediately, because we're in a situation where, when we were discussing the risk-based pricing, it's been going on for in excess of a year.
Yeah.
The whole macroeconomic environment has changed, right? So we're seeing various moving parts in this, and that has put strain. Like we said, inflation is putting strain on people's finances, right? So that might in itself change risk profile. So I think the direction of travel is yes, absolutely. We should be better, because I don't think it's in anybody's interest to have high interest rates, excuse the pun. I mean, we want to have affordable lending so that we can have more of it, which will drive people's lifestyles, livelihoods, and drive the economy. But I think we've still got this uncertain macro environment, which might make banks a little bit tentative. Obviously, we're waiting to see the outcome of the elections. I don't think that should drive it per se.
Correct, yeah.
But sometimes when there's an uncertain environment, people don't want to rush headlong. And we've already talked about the fact that we've seen an increase in defaults. Yeah, we're seeing an increase in non-performing loans.
Yeah.
So that might be the slight handbrake. Yeah. On the speed of execution and the ability for rates to come down. But in general, I think we will see it over time happening.
All right. And in closing, Jeremy, we did see an interesting trend also happening when you look at the demand for the dollar. The demand for the dollar did put a lot of pressure on the shilling. We're seeing exchange rates now oscillating about 119 to the greenback, and earlier on, of course, there are concerns around a dollar shortage of sorts. Has the situation improved? Are you seeing more availability of the dollar in the market, and how does this fit in on the geopolitical standpoint, where we did see the US, of course, hiking their interest rates?
Yeah, I mean, I think there's many factors that affect what you've mentioned. Ultimately, the macro factors, I think, have been a large driver in terms of driving the demand for dollars, right? I mean, I think as things started getting tighter, I think people were looking at moving money from emerging markets back into their core markets, especially as interest rates start being pushed up. In US, in parts of Europe. So I think that did create pressure. And then we also came into the election cycle, right, where people always start. You've got some quarters of the public who start, wondering what's going to happen, and they take defensive moves, as you've seen people buying dollars, leaving it in dollar deposits, even if it's in the country. So I think these are just periodic things that will happen.
All right.
I think also we saw, like I mentioned, the supply chain issues. We also saw, because of the Russia-Ukraine crisis, we've all seen and felt the impact of fuel. Right?
Yeah.
So that has meant we're having to use much more dollars to buy that fuel.
Sure.
So, but I think, overall, we would hope it settles down. And then we obviously will, under the leadership of the central bank, manage that process, working closely with them as banks.
All right. And your closing thoughts, Jeremy. You've declared an interesting dividend of about 20 cents. Talk to the shareholders. What should they expect in the next half year?
We were pleased to be able to give our shareholders a return at the halfway, and I think that's also in recognition of the fact that, if we can give our shareholders dividend now rather than making them wait until the end of the year, then that's a positive thing. I think it should signal our confidence, in terms of our full year performance. Obviously, we can't give forward guidance at this point, but I think if you look at the trend, our business is doing well. It's been growing quarter on quarter, half on half, year on year. So we're positive about our outlook, we're well capitalized, and that's why we felt confident that we could pay out. So as you would imagine, I think Absa is a good business to invest in, right? So, and we're showing that in our dividend.
All right. Man, thanks for your time, and we'll definitely keep an eye just to see how the stock performs as well. And definitely some market actions from Absa.
Thanks, Abi. Thank
All
you.
right. Well, we've been speaking there to Jeremy Awori, the Managing Director for Absa Kenya. He's quite optimistic of what lies ahead for the economy, and indeed some interesting performance there on their half-year results. Well, that brings us to the end for this week's edition of the Trading Bell. We now leave you with a market update. My name is Abi Agina. Until next time, keep safe.